good to see you all again. I think we met briefly early on, and I hope you guys are having a great time. I know Demo Day is coming up soon. So my name is Josh Bear. I helped start Capital Factory. Started my first company in my dorm room in the kind of mid to late 90s, and I studied computers, and that was web internet 1.0. And bootstrapped that business, grew it up to a couple $1 million in revenue and about 60 employees, and sold that. So it wasn't a huge exit, but I own the whole thing, so it's huge for me. Then I've done 2 other startups that I've done. Last one was called Other Inbox, and we raised about $4 million in angel funding for that. Got a couple million people using that, and sold it about 2 years ago. And very active angel investor. Probably invested in about 100 startups, and yeah, that's my story.
And David, just talk a little bit, just your fundraising history.
Okay, my first company, MarketSpan, bootstrapped, no investors other than my partner and myself.
Might see a trend here of all this.
Second company, which is going on now, is MarketSpan. Is Monotape. And actually, Carrie and I worked together at MarketSpan back in the day, 99 to 2000. We worked together. And Monotape, which is going on now, we've raised $45 million. Our venture funding.
Bootstrap.
Yeah. Slightly different when I sold MarketSpan. I think we were at what, 47, 48 employees, something like that.
Oh my God.
We're at over 220 at Monotape now. So I've been an angel investor, have a portfolio of about 9 or 10 venture funds that I'm a limited partner in, as well as about 26, 27 direct investments. Stopped doing angel investing when I started Dreamit. Steve, Mike, and I agreed that it would be problematic for us to invest in some companies and not others. So that's one of the things that we do through the Dreamit Fund. So Dreamit Fund 2 does invest in all companies that meet the criteria that we set, as you guys know from your offer letters. We'll invest up to 25% of your first post-Dreamit round, as long as it's $250,000 or more and led by a professional investor.
So let's jump right in and talk about AngelList. And Josh, you're probably one of the most experienced people and active people in AngelList. Why do you use AngelList, and why do you think it works with AngelList from both your perspective and from the entrepreneur's perspective?
Yeah, so I'm a big fan of AngelList, and I've been using it for a while. That's actually how I raised. So we've got a lot of it, the angel investors for Other Inbox. I've helped lots of other companies raise millions of dollars through AngelList. AngelList, kind of like South by Southwest, like it keeps changing and growing. Like what AngelList is now is not what it was 3 or 4 years ago when I raised money for Other Inbox. And so I think that's an important thing just to realize, is that it's a startup itself, and it's evolving and changing. So I think for companies that are not in Silicon Valley in particular, it's a really great tool for helping to bring in money from the other coasts. And so typically in that type of situation, you want to try to get some kind of a base of investors first, so you can show some traction with investors, but then use that to go out and get investors from outside of Austin or other places. I think the stuff that we do with syndicates is really interesting right now, and seems to be working at causing more liquidity, causing people to invest more and more quickly, and allowing you to take smaller
Can you talk about the syndicate group for those that haven't seen it?
Yeah, I will. And then I think, the other thing just that's great about the AngelList is, so 2 things. One is that it has all these investors listed on there, and they're all kind of categorized and tagged and sorted. And so I think people that do really well with AngelList, it's not like they just put their profile up. They put their profile up, and then they spend, 5 or 6 hours trolling through it, making a list of who all the best people are that they want to talk to, that are going to be a good fit for them, that have invested in companies like theirs, that like this space, that have some reason why they'd be affiliated, and try to reach out to those. And then the syndicate side of it is a new thing that they've developed, and it basically is a way for you to partition off like a chunk of your round and give it to someone, like basically an angel, to go lead. It effectively turns angel investors into mini VCs, but makes it really easy for them by reducing the friction, so that to set up the VC, it's a few clicks. It's kind of like DocuSign versus not. You have to go hire lawyers and do all this paperwork and all these other things. And they take all the expenses or the fees and load out of it. So you can set up this syndicate, and it doesn't cost anything to set it up or to maintain it, things like that. And then what AngelList does is they take a carry on the syndicate. So just of the money that gets made, the profits, they get a 5% carry. So because they paid up front to create the LLC and other things that needed to make this happen, they get some money on the back end, and that's their real business model. And then typically whoever's putting it together also gets some carry as well. And the other thing that's really great about it so two things that are great about it for you as a company. One, typically a good syndicate leader is going to build up a pool of people that have said, okay, I'm in your syndicate for all your companies, no matter which company you do, I'll fund them. And so that way, when you get somebody like that in your deal, you can just instantly have some momentum in your fundraising. You might start off with $50,000 or $100,000 in your syndicate as you then go get other people to join in. And then the other big benefit is that the way the syndicate works is they create an LLC. The LLC is what invests in your company, and all the syndicate members are part of that LLC. That allows you to have really small angel investors, so someone can invest $1,000 if you want to let them in through the syndicate. But it also means that you can have all these little investors and only actually have them show up on your cap table as one line in one company, which means like when you need to go get the signatures of all your investors, you don't have to go track down the person that invested $1,000 and get a signature from them. You can just get that one signature from the syndicate. And so the two syndicates that I'm running, which seem to be working pretty well so far, the first one I did is I have a personal syndicate for me. My investment theory is I invest in Austin companies and email companies. Those are the two things I feel like I can really help a lot and know a lot about. And so I'll invest in email companies anywhere in the world because I've done 3 email companies. I know a bunch about those. I can help those and I can have some advantage there. And I invest in email companies, Austin companies primarily through capital factories, how David described. And so with the email companies, I created an email syndicate and I said, hey, I'm only going to invest in email companies. That's what the syndicate's for. I'm looking for the best ones. I went and I recruited other email investors or people that had started email companies and got them to be the first people lined up in my syndicate. So it's like, oh wow, if you get in Josh's syndicate, you're getting investment from Dean Draco, who founded Barracuda Networks, and Scott Petrie, who founded Postini, and Bill Babel, who founded Webmail, and you get so it's like, wow, all these email people in my deal, and that makes it even better. And then hopefully that means that we'll get the best deal flow, that everybody that starts an email company is going to come to us and say, hey, we want your syndicate to invest because you're going to bring in all these email people. And then with Capital Factory, we're doing it more as a, follow the Capital Factory investments, invest in Austin kind of thing.
So how much, you said something, it's a good place to get momentum. What do you think you have to start with there? What's the starting point? When you look at companies that have been successful angels, what are they going onto the platform with publicly?
That's going to change over time too. And so it used to be at the beginning, a lot of people would say like, well, don't even put it on AngelList until you already have like half your round filled out, so you can just launch and have a bunch of traction and go. I don't think that's as big a deal anymore. I feel like there's so much happening on AngelList. It's so noisy that it's not a big deal to put your profile up there empty because just no one will see it. It's like putting a web page up that nobody will see. So I would say, generally get it up early and then you build momentum by having people follow you, comment on your profile, and ideally put themselves as investors. And I think the magic spot's about halfway of whatever you're raising. It's not so much that it's an exact amount of money. Certainly it's certainly $100,000 or $200,000. But a lot of times with AngelList, you can specify like how much you're raising, and I will usually sandbag that and have them say they're raising $500K. I'll tell them to put $300K because you can always increase the amount. And that way you show what you want to see is a little thermometer, and you want to see that you're halfway there faster, right? And so you can, if I'm making a $300K, then you're at $150K, you're halfway there. People can go, oh, this deal's halfway done. It's gonna close, it's gonna fill up. Okay, I'll participate too. And then you can hopefully be oversubscribed and just raise your amount.
David, angel groups. Why do people get in the angel groups and why they matter to these guys?
Well, I'm somewhat jaded, having been president of an angel group, chairman of an angel fund, and angel funds work differently from angel groups. Angel groups tend to be individual investors who decide on a deal-by-deal basis whether to invest and if so, how much to invest. Angel funds are where capital is pre-committed by the investors, and that capital gets called as the fund makes investments. So, people understand that distinction? So I've been president of an angel group, chairman of an angel fund, and not happy with either of those models, which is what led to the starting of Dreamit. Steve and I were investment partners in an angel group together. And Mike was a member of that group as well. People join angel groups largely, I think, because they're lazy. They make money, they want to invest in startups, and you find this all the way up the investment chain to the best VCs in the country, private equity firms. Nobody wants to go first. So people feel that there's comfort in investing with a group. So the theory behind angel groups is great, which is we'll only invest in a company where at least one of our members has expertise. So you rely on them to do the diligence and to evaluate the opportunity, and then you invest based on that person's recommendation. But the reality is nobody is really a professional investor in that group. So people can become enamored or disgusted by things that don't really matter, and then everybody else is just following along and tagging along with that decision. There are very few angel groups that have true discipline and true underwriting and measure have the same investment philosophy that they execute on throughout. Angel funds sometimes bring a little bit more discipline, but generally, again, they're usually run not by professional investors, but by the members of the investors in the angel fund. So it's usually people who have made some money, want to play in the startup world, want to be able to at cocktail parties say, I'm invested in these 5 exciting startups, but who don't really contribute value to the company, and generally are investing on an undisciplined basis. So that's a very jaded view of angel groups generally.
So should these companies avoid them?
Well, no, you shouldn't avoid them if the only thing that you need is money. If you're expecting them to actually deliver help, introductions, finding resources for you, most will disappoint you. There are some that do a better job than others. So, for example, Ron Conway he's a super angel, one of the early investors in Google, early investor in Facebook. And out in the Valley, when the Valley was really starting to gain momentum as a technology startup force, Ron, because he did contribute value and had a tremendous network and worked hard for the companies, but also in part by serendipity because he had all of these good deals, Ron would be able to aggregate capital for you pretty quickly and get you off the ground pretty quickly. But I think that he was atypical, and that's not the general experience with angel groups. But sometimes the only thing you need is money, or the only thing you can get is money, and then their money's as good as anybody else's.
Yeah, I would add too. I just think, everything he said I agree with. The way I think about angel groups is, first of all, we have CTN here in Austin, which is an awesome angel group as far as they go. It's big and they write a lot of checks. That's the starting point of being a good angel group. I agree with all the things that David said. I would say as you think about angel groups, they're probably one of your last resorts. They're not the first place you go for money, because you'd rather go to some awesome VC that's just gonna have all the money you need and bring all these other connections and other stuff. Or if not then some awesome angel investor who's gonna have a bunch of experience and other things to bring to the table and bringing other people with them and things like that. The couple reasons I wouldn't go to an angel group first is, one, I find that there's this concept of groupthink, a bunch of people making a decision together versus people making a decision individually, and you get the worst possible deal kind of out of that. The angel groups, you're gonna have a million people going well, let's ask for this too, and get this thing in there, and you just don't end up with a very founder-friendly term sheet usually. It ends up, so if you're gonna work with an angel group, the first thing I'd say is you generally want them to follow, not lead. So go get a couple other angel investors first, and then go to pitch CTN and say, hey, fill out my round. And get them to, you've already got the deal put together, then it's just more money being piled on, which is great. So the one thing is that, and then the second thing, they kind of go together, the terms part as well. Just they typically tend to not be the founders and kind of previous entrepreneurs, but more other people that are financially well off, and so you just get a different investment.
Can you guys think of an example where taking in the wrong money doomed a company?
Oh, there are lots of them. I luckily haven't experienced it. But one of the things, for example, at Monete, one of the things that we did was we do tremendous diligence on our investors. We kind of view it, and now we do have some fair advantages that most people in their first startup don't have. But we will that we view the investors as we're interviewing them, right? We're diligencing them, they're not diligencing us. And they're my partner in MarketSpan, who Kerry worked for even before MarketSpan, had a company before the one that Kerry had worked at, where a very significant VC in the Philadelphia area had made an investment. The business model of this VC, it wasn't actually, it had a VC arm, but it was more of an operational company. And their model was to just run out the revenue stream, not investment product, not investment improvement, just run out the revenue stream. So you had a founder who is totally vested in the success, the ongoing success of the company and creation of value. And you had an investor whose business model was just run out the revenue stream and then kill it. And that company died. In fact, my partner, after we had already exited MarketSpan, got the check from got the distribution from the dissolution of that company, and it was, I think, $3,300. And that was about 4 years worth of work, and building what at the time, prior to that investment, was a real successful company. So it's really easy. You'll get a good inkling during the negotiations. That's the first measure of whether this is a founder-friendly investor or not. If they're asking for terms like multiple liquidation preferences or participating preferred, other and these terms may not mean anything to you, but they're right now is fairly standard founder-friendly terms in the capital markets. And your lawyers can help you figure those out, and we can help you with that as well. But if you're getting predatory terms, run fast, continue bootstrapping. Another thing is talk to the portfolio companies, not only the existing portfolio companies, but those that are no longer in the portfolio. VCs in particular are wonderful, just absolutely incredible when things are going well. They want to contribute to your success. They want to be able to go to their partner meetings on Monday and say, I was able to find this company as CMO. And as a result of my finding that company as CMO, sales in this year grew, up to 150%. So they take personal credit, it's their careers, right? When things go badly, then then true colors tend to shine. And we did this with the venture debt line that we took. We were considering 2 very, very prominent name brands for the venture debt, and we found that they were both great when things were going well, and one was much better than the other. Was a big boy about it when things went badly, and took the keys to the company, and that was it. Another one of these banks were asking for personal guarantees and stuff like that after things started to turn. We'll put more money in, but we need a personal guarantee, stuff like that. And it can ruin a company, and it can ruin an entrepreneur individually as well.
So Josh, if you see them get themselves screwed by taking the wrong money. I don't want actual names.
Yeah, fortunately, I don't have a lot of direct, terrible things happening. I mean, the things that I really, one example where it didn't happen, but it almost did, is just, and this is just a very specific example, so I'll give it, although it's actually a restaurant deal, not a tech deal, but one of my co-investors in a restaurant came to me and said, hey, we've got this, and they're not an experienced investor. He said, I'm looking, we have this, I'm wondering, and the business is generally doing well. Like, it's a restaurant, it's doing well, it has record months, it's paying out well, it's not like things are going terribly or something. And he's like, I think maybe something's funny's going on with this thing over here. Like, I just feel like maybe there should be more money from this, or should be something else. And he's like, there's this clause in our thing that says, we can demand an audit, right? And they have to do it, and and then we can audit it to find out what's going on. So I was thinking about, asking them to do an audit. What do you think about that? And I was just like, don't do that. Oh my God, that's declaring war on the startup, on the company. Do you realize what it's gonna cost the company to do the audit? You're gonna completely distract the people running the company for a month or two. They're gonna spend a bunch of money on the audit. We're gonna do all these things. like, if you really think something's really bad and wrong, then that is something you can pursue, but there's a whole million things you should do before you ask. It's not like, you're not just like casually like, hey, our contract says we can ask for an audit, so we're gonna ask for an audit. Like, no, that's like a big fucking deal. And I think, as an inexperienced investor, he wasn't trying to cause much problems for them. He didn't understand that, like, oh, well, this is actually, just because it's in the agreement doesn't mean it's not a big deal to do it, or that I could be causing harm to the company by doing it, or just being too nosy or too, it's like, and so what you don't want to have is a small investor that's kind of like up in your pants all the time, like asking you all these questions and demanding things and like, doing other things like that when they don't understand the business and they really don't understand what they're asking about. And so I think that would be one danger of the wrong kind of investor, who doesn't have the right attitude. The other big thing is just kind of what kind of rights they get. And so, I'm really big about control. I often, advice I'll give is like focus more on control than on valuation. So I'm less concerned with how much of the, and a lot of people think originally that those things are the same, that like whoever has 51% of the company controls the company, and that's not at all true. It's whoever you agree controls the company, controls the company. And that's generally the board, like that's the board makeup. So if there's 3 board members and you have 2 board seats, then you control it. And that's almost the end of the story. On top of that, there can be they might have specific rules that say, particularly if you usually bring in a VC, they'll say, okay, well, you might have 2 board seats, but it requires unanimous consent. We need to have everybody agree, which means they can block something in order to go raise another round of funding, in order to do certain other things, sell the company. And then if you have the wrong investor or by the wrong investor maybe, if you just don't have well-aligned goals about what you're gonna do with the company, you might get to a point where you wanna sell the company or you wanna take more money from someone and they block it. They say no, because it didn't fit with where they think the company's gonna go. And I know that that's having a good investor or a bad investor, but it's having a bad investor for you because you're not aligned on where it's going to go or what's going to happen. And then maybe the last thing is just, a bad investor is going to yank you out of being CEO too early.
Good investors may do that as well.
No, that's it, too early. Like, maybe there's a right to do that, but they might do that in a way that's inappropriate or too soon.
And let me riff a little bit on Josh's last point, which is, and I can use myself as an example here. I love the innovation phase. Okay, that's where I feel I can contribute most value and where I also have the most fun. I can do the expansion stage, I can't do the growth stage. I've never done it. Montate right now is in a growth stage. I'm chairman, but I'm not involved in daily operations. And part of it is because I don't want to be, but I also think if I were chairman and if I had an operational role, I'd probably remove myself for incompetence. So all of you, hopefully, are great at launching your businesses, but you may not be the right people to take it to the next level. And you have to understand that if a VC is saying, you missed your numbers for these 3 consecutive quarters, you're not able to predict revenue or expense, we need to replace you, that's not because they don't like you. They may be right. You may not be the right person to take the company to its next level. And candidly, if your partners tell you that, if people who are involved, it is not a personal thing. The company has to do what's best for the company. And everybody has to have that in mind at every stage.
Can I ask a question about that?
Absolutely. Sure.
So I heard, and this might be hearsay, but I heard that there's a difference in culture between Silicon VCs and Austin VCs in terms of how early they like to do that. Austin VCs wanting to do it earlier. Can you comment on that?
I can't comment on Austin.
Wanting to take the CEO out earlier? Yeah.
Wanting to take out founders earlier. Okay.
Yeah, on the East Coast, it's the opposite. The West Coast tends to pull the trigger faster, but the West Coast also tends to have more repeat entrepreneurs. So maybe just in terms of sheer numbers, to take an example, Scott Dorsey, the founder of ExactTarget, he's now doing all of the social and other aspects for Salesforce. If Scott wanted to start a company, people would just give him money and sit back, kick up their heels, and say, let us know when you're done. Right? Because he's taking it from founder to exit. And not only, he took it from founder to going public to being acquired. So he has the experience, he has the temperament, he's got everything.
I've also heard several stories, like it depends on if they want to restructure the company and wipe out the CEO, or if they want, I think that's important, because I've heard of horror stories on the West Coast of, investor going in and just wiping out all the angels, all the founders, and then starting.
Cram down rounds are nasty. Yeah. The point is, though, that you have to have options.
What is a cram down round?
A cram down round is, okay, everybody will take simple math, and Josh joined me in this. We'll do simple math and a simple example. You're going out and you're raising your round. You're raising your round, let's say, at a $5 million post-money valuation. Everybody understand what that is? Shake your head no. I'm happy to explain it if you don't. Okay. So you have a $5 million post-money valuation. Next round, you've got VCs coming in, and you've hit your milestones. You're ready to then investable at a higher amount. People are coming in at a $10 million post-money valuation. Now you hit some rough times, and you're running out of money. You need money. Somebody comes in and says, "Okay, we'll give you more money, but we're going to do it at a $2.5 million valuation." You want the money? Great. Everybody else who had invested at those, let's say at the $10 million valuation, the new shareholders own 10% of the company. They put $1 million in at the $9 million pre, $10 million post, so they own 10% of the company. Right now, what's going to happen when they get crammed down? We're going to give you another $2.5 million, but it's going to be at a $2.5 million pre. So we're going to own 50% of the company. So that the guys who had 10% now have 5%. Is the way that works. And founders can get, if you own 50% before that round, combined all the founders, now you're owning 25% of that.
And so as a company, when an investor puts in money at a $5 million valuation, their kind of scenario they're expecting is then you're going to raise money at a $10 million valuation. It's going to keep going up. And so they will keep owning a smaller part of the company, but it won't decrease too fast because, again, that's the pie example of, smaller slice of the pie, but the pie is getting bigger. So that's okay because the total amount of pie I have is still getting bigger. And in a cram down round, your total amount of pie got smaller. And it's like, hey, it's almost like I just bought something for $10 and now you just sold it to somebody else for $2. Wait a minute, like I overpaid for what I did. So that feels bad, and that's the cram down.
People get that, or should we go through another example?
And so that's anytime you're in that situation, that's very difficult. Honestly, that's the biggest argument for not raising your valuation too high too quickly. This is an interesting conversation I have with a lot of entrepreneurs where they feel like their race or their game is how do I get my valuation as high as possible. And it depends what game you're playing. And if you're only shooting for home runs and you're going all the way, then that might be an okay strategy. But for most of the companies I'm talking to, where they don't know exactly where the thing's going to go, raising money at too high a valuation limits a lot of your options. And so, for example, combining all these things we talked about with having maybe a bad investor or one that's not well aligned with you and raising money at too high of a valuation, you raise money at a $10 million valuation. Somebody comes along and offers to buy the company for $15 million. You might own half the company and think, hey, I'm going to pay back my investors and I'm going to make $3 million. I've been working on this for 1.5 years. This actually is not bad of a deal. Like maybe I had a bigger expectation for it, but maybe it's not going quite the way I expected. And that seems a pretty good outcome. My investors all get their money back. They make some money. I put a couple $1 million in my pocket. Great, let's move on and go buy. But your investor that put in money at the $10 million valuation might go, well, no. I'm not okay with only getting 1.5 times my money. Like I put this money in to try to go get 10 times my money, and I think there's a bigger opportunity here. I want you to go, run harder, go do more. And they can, because they might have that blocking, right? They can say, no, you can't raise that money, or you can't sell the company because it's too high. But if you had done it at a $5 million valuation, they probably would have let you sell the company because the multiple would have been better. They would have made more money on it. It kind of would have worked. And so you can get yourself in that situation. The other situation would be you raise money and then you have to do a down round. If you had kept the valuation lower, maybe it could have been a flat round or still been some other problem.
Could you not just negotiate with them in that case, like with those individual investors?
Oh yeah. But
That's what it is. It's a negotiation.
You know how that negotiation usually goes? On the math, you should walk away with $2 million of this $15 million sale. We'll agree to do that, but we need to achieve our return multiple. So we need you to give us $1 million of what you would otherwise get as a preferred return for us, so we can achieve our return multiple and you can sell the company. And so taking money out of your pocket to get the deal done.
In a legal way.
Yeah.
Does this also apply to when you're setting a valuation cap on a convertible note?
Not as much.
Yeah, I'm with you on that.
Yeah. I mean, I think a lot of people overthink the caps. I don't get too worried about it. The cap's just a cap. So if things don't work out as well, you just get a lower number. And you haven't locked yourself in at that higher cap number.
The problem you have with a cap typically is that then becomes the highest amount at which an investor will invest. So, and there are ways to defend against this, but the argument you will hear is that you took in $1 million 2 years ago at a $4 million cap, pre-money cap. Okay, now sales have gone through the roof. You've got all this value, et cetera, et cetera. You're out getting your next round of financing, and the investor will say, "Well, you guys anticipated that the most that this company would be worth when you did your next round was $4 million, and I'm happy to give you that. Come on, guys, you got to be reasonable here. Right? I'm giving you exactly what you had anticipated. Deal?"
And while we talk about notes, so a little bit of the flip side of it, but as much as I think we are generally very founder friendly, two investor friendly terms that I always push for in any note that I do is fairly new, probably in the past year or two, as I've now done a lot of notes and seen how these things work out. And these are both things that make me feel much more comfortable with them. Then I don't care about the capital. I'm just like, whatever, I'll roll with it. Is one, I ask for a 2x liquidation preference on the note. So I say, look, if I'm putting money in this note, we don't know when it's going to happen or how fast it's going to happen. At least my intent in investing this is I want to double my money. And so if you go sell the company before the note converts, which is really all we're talking about in this scenario, if things go really well and you flip the company, at least I'm going to double my money. Is like what I'm trying to get out of it. But a part of also saying that expectation up front. I say to them, this is my goal. Like I want to at least double my money. So if you don't, you expect that going in. And the other thing we've recently started adding is if you reach the maturity of the note without it converting, so if you go through the end of it and it didn't convert, a lot of founders try to throw in something that says, well, then it'll just convert at the cap, which is very good for them, but really doesn't make sense. It's basically saying that because almost always in that scenario, things didn't work the way you wanted them to, because you didn't raise money. And so you shouldn't get the best possible valuation. And so what we usually say is that it'll convert at 50% of the cap. That if you get to, goes for a year and a half and you raised it, you had a $4 million cap and you didn't get there, then it converts at a $2 million one. And I don't think that's by any means like widespread common stuff. That's something that's a little bit new for us, but we're trying to hedge a little bit on the other side of like, how do we avoid some of the downside situations of the note? And then if those two things are there, then I worry much less about the note, because if you get the really high valuation, that means things are going really, really well. And I'm glad to be in the deal. But if things don't work out, I didn't sign up for this really high valuation. Things actually didn't go that well.
I have a question on, so you used the term liquidation preference, and I remember earlier when we had you mentioned something about a form of liquidation where you get your 2x return and then it splits up based on the equity portions.
That's the participating version.
Participating.
Yeah.
Yeah, that I view as predatory.
Yeah.
And it's also different to have a liquidation preference in the note as opposed to having liquidation preference on equity. Okay, because if I understand Josh's note terms,
Once it converts,
you're part of that
Then you
same
get
flavor of
part of
equity
exactly.
that follows.
This is all in the something happens before the note converts
Right.
situation,
Oh, okay, so
which is what we're protecting against.
So you get your
Most
2x
notes, it's
return.
actually not very well defined what happens if the note doesn't convert.
So you would get 2x return and then nothing else on top.
Yeah, typically if it's non-participating, which is what you want, then what that really means typically is the investor will have the choice of either participating the way everybody else would or taking their 2x. And so in their case, if the 2x is greater than what they would get if they just did their pro rata, their portion, then they would take that instead. They wouldn't get anything on top of that. They would just get the 2x.
Other questions?
I have another. What's the importance of geography on the investments that you decide?
Well, in Texas, one of the things which is very interesting about Texas in general is that it really does view itself as a separate sovereignty. And the people, the
Welcome to the
investors,
country of Texas.
yeah, the people,
Or Republic, Josh.
the investors here, I have found, really don't care much about the rest of the country. They want to invest in Texas, and they want to invest in Texas companies. There are exceptions to that, but in general, it is a much more provincial investment philosophy than I have seen anywhere else in the country.
Yeah, I'll take some credit for that. It certainly is like I kind of said to you guys earlier, like my theory is like, and part of me, it just makes it easier. Like I need a reason to say no, and it's just easy. Like, okay, you fit in this bucket or this bucket? No, okay, because I got enough things to look at. But I also, I want to invest in things that I can be, sometimes why you're investing, but I'm investing because I want to be involved. It's very hard to be involved if you're not there, and I want to be able to help, and it's very hard for me to help if I'm not there. And so I only invest in Austin companies. And I think there are quite a few people that generally feel that way. Now, again, for me, it's like I have a bunch of expertise in email. If you bring me an email deal anywhere, then I'm gonna understand it better. I'm gonna empathize with it. I'm much more likely to get excited about it and do something even though it's not in Austin. And that's probably true for everybody as well, right? Like, if you come to them with the right deal that's really a great fit for them, then they might not care where it is. But Austin people Texas people tend to like Texas. The nice thing is not everybody else is like that. So that's kind of like we get to have our cake and eat it too. We only invest in Austin companies, but we get everyone else to invest in Austin companies too. And so that's things like AngelList, and other things like that. And what I like about AngelList is you can specifically find people who have said, I will invest anywhere or I will invest in Austin. And you can go make lists of those investors and use those so you reach out to people that you aren't wasting your time on. But like Ron Conway, and that's a great example. Ron Conway, really famous, prolific investor, generally only invests in Silicon Valley. But again, unless he really likes you, because he's invested in quite a few companies that are here, but just like, it's just a higher bar, for that type of situation, for them to go outside of their comfort area. But the nice thing is that there are more and more people investing everywhere, both people from Silicon Valley and international money that's looking for places to put itself. And there's a different perspective of people that go, oh, I don't want to invest in Silicon Valley because the valuations are way higher, because it's much more competitive, and they're actually looking specifically for other markets to go invest in.
Yeah, I'm just following up on Ron for a moment. I have a pretty good passing relationship with Ron. I mean, we don't go on buddy trips together or anything, but got a pretty good relationship with him. And Kerry has a very good relationship with his son, who is also a very active investor. And I don't think that we have succeeded in getting funding for any Dreamit company from Ron or Ronnie. Yeah. So it's coming from sources that they trust, sources that they like, but it hasn't been a Silicon Valley deal. And where we have had Silicon Valley deals, people like Sequoia are investing in those Dreamit companies.
You guys both talk about success criteria. Like I've heard on the West Coast, people don't care about metrics as much in the early stages. And then in Texas, people are all about metrics. And that's the only way you get to a Series A. Just comment.
Yeah, well, since the question was more Texas oriented.
Yeah, I think that's probably a fair initial assumption. And I think in California, it's not that people don't care. I think it's probably they look at different metrics. And so there's the biggest difference there is going to be businesses that are fairly consumer oriented that involve building up a large user base before you can monetize it. And I'd say that's where it really becomes an issue. And there, it's easier to do that in Silicon Valley. It's easier to have people believe that you can get there, to be willing to make that bet, and also to do it just based on user traction and showing people are using the product. In Austin in particular, and certainly in Texas, it's much more of a bootstrappy kind of revenue focused perspective. And so they're looking for metrics around, particularly usage and users, but more importantly, even kind of customers and revenue. And it's not that you can't get that deal done. It's that the world of people you can talk to is cut by 9%. So it's like, it's much easier to get the deal done when it's like, yeah, we've got 20 grand a month in revenue, and we're adding customers this kind of way, we understand our customer model and things like that, and we're scaling that, versus hey, we're adding this many users per month and things like that. There are people in Austin who get that and are going to be more sympathetic to it and will buy onto those. And then in Austin, if you get a bunch of those people in, then the other people will start to follow, because they know, Andrew Busey is like an example of one of those people. Andrew is a prolific serial entrepreneur in Austin. He founded living.com, iChat, most recently did a company that he sold to Zynga called Challenge Games. He's running a company right now called Banter. So he's just this prolific serial entrepreneur. He's done a bunch of consumer stuff. He understands customer acquisition, gaming, and valuations. He's gotten funded by Sequoia and a bunch of other non-Austin companies. And so he's really seen as a leader there. He's both willing to make the bet, like because he's experienced it himself and he's done it, and he's a leader. When other people see, oh, well, it's a consumer deal. Oh, but Busey's in the deal. Okay, well then maybe I'll take a look at it.
What's his name?
Andrew Busey.
He just got 6 emails.
Right.
I hope. Seriously.
Yeah.
What'd you say?
He said he just got 6 emails.
Oh. I can do an intro.
Other questions?
Have you ever seen like a company go from like, a venture investment to, one round of venture investment straight to private equity, or from going from like bootstrap to private equity? And what are your thoughts about that? Like, is that a path for some companies, or is that not really realistic?
Yeah, no, it's a path for many companies. I've seen companies go from one round of funding to IPO, Viva in Philadelphia, and they're both East and West Coast based, Silicon Valley and Philadelphia. They went public last year, or maybe it was the year before now, and they took in a total of $10 million. That's all of the capital that they took in. Those are great stories, right? I mean, these guys do extremely well personally in that situation. The founders just do great, and the early employees do incredibly well. It's really, there's no magic to the letter on your round of funding, to whatever series it is. The question is really, how much capital do you need to have this business hit the third stage rocket going off?
Okay. And do private equity firms have a lower expectation of like explosive growth?
Yeah, thanks. The private equity piece.
Yeah.
Private equity is looking for a market that they can dominate in most instances. So it's, I can take this piece and this piece, put it together, or I can take this piece and use it as a platform to really just strive for the monopoly is a lot of what the private equity model is. If you're thinking Warburg Pincus or people like that, that's what they do. And they'll put tons of money in to make it happen. My suggestion is when you start talking to PE firms, that's time for you to consider a recap, because otherwise you may not see liquidity for a long time. So, and a recap would be you take money off the table, you'll sell part of your interest to the private equity firm, so you get a significant payday at that point in time. A PE firm is really no different than venture, just at a higher valuation, a lot more money invested.
Yeah, and typically that's going to be a bootstrap company that got up to sizable revenues, tens of millions of dollars, but then, really has eliminated most of the risk and gets interesting to them to come in and operate. And I'd say another characteristic of that is that typically, like a PE firm is going to generally not take any risk. Like there should be no chance they're going to lose their money. The question might be on the multiple, like how much they make, but they're generally not taking any risk. Your business has to be very, very solid and understood, because they're expecting there's almost no chance that it's going to lose value. So it's not anything generally that any of you would be considering anytime soon. Just because,
But how is that different than like a bank loan? If the business is that established, why do people choose private equity?
banks don't loan $30 million.
Okay, fair enough.
And banks don't allow you to.
Well, they do.
What?
They do if you have receivables that you can collateralize, or if you have hard assets like real estate that you can collateralize. I'm sorry, you know banks pretty well.
Yeah, no, I think the other advantage is the private equity firm allows you to recap. Banks not going to let you take $30 million, put 20 of it in your pocket.
Right.
Gotcha.
Which is very common in those situations, is that the founder gets liquidity.
Thank you.
So what do you see as an optimal role for the investor once they've invested? Like, how often should the founder be talking to them? How much control, how much power over decisions should an investor have?
Can I also frame that, and this I think will lead into it. How have you seen, what's the best way you've seen companies manage their investors?
Yeah.
So first of all, there's going to be two kinds of investors from that perspective. There's going to be an investor that's on your board and everybody else. And so the one that's on your board is very different. They're a board member. They have a fiduciary responsibility. They're helping you run the company. They're somebody you're talking to regularly and reporting to in many ways. So now I'm going to talk about everybody else. So everybody else, you should think of them as they should be a resource that's there to help you on top of the money. And you should be thinking about, how do I get the most out of them? And think of it that way. It's like I have this pool of people that now have a vested interest in me being successful. How do I get the most out of them to be helpful? And typically that's going to be, in my experience, that's going to be by sending them at these early stages a monthly or bi-monthly email. So every month or every other month, sending them like some kind of an update, trying to have that have a consistent format so it's easy for them to look at it and like look at the next one and really understand what changed from this one to this one, or get to learn to expect how to read and process them. You're going to report on a lot of the obvious things, same things you might report on in a board deck, but kind of traction, revenue growth, customers, big changes, team changes, things like that. And then you're going to have an ask. And so my investor updates would always start and end with the ask, right? It was like the top in all caps, because you never know how much of it they're going to read or what they're going to read. It was just like, here's what I need help with. I'm trying to hire these kinds of people. I need introductions. I'm looking for more investors that want to get involved. I'm having a problem. Does anybody know somebody at Yahoo? And I would kind of put my asks up there and try to always have 2 or 3 asks. Then I'd give my business update. And then I would just copy and paste the exact same thing to the end. Here's what I need, and for me, it was really all about, giving them an update, but the purpose of the update was to find out how they could help you.
Yeah, I agree that the board member is a different character, because the board member has an obligation to try and help you any way that they can. They also have a duty to who they represent on the board, whether it's an investor or whether it's themselves as an investor. So, or whether they're an independent board member, then they are supposed to be exercising judgment on behalf of all the shareholders. But you will find, it's like anything else, there are investors who you think are full of shit and don't add any value at all. And they may be insinuating themselves into the business, and what you're trying to do is figure out ways to compartmentalize them and limit the distraction and keep them off to the side and placate them so that they're less of a distraction. And then there are others who can be great business mentors, who have access to either capital, resources, talent, whatever it is, and you lean on them very heavily. But it really depends on the individual board member.
I'll send out, when we get back, SnipSnap, I think, does the best monthly updates of any company we've had in the Dreamit portfolio. I'll send you out an example of that, because I think they do a great job.
And you guys should get in the habit of doing that, even if it's just us at this point.
Yeah.
You should be doing monthly updates for your team, for investors, and it's a habit that is good to get into, and it's one that's hard to start if you don't do it.
And I would write one long one, and then I would send that to the board. And then I would delete like 2 paragraphs and send that to investors. And I would delete like 1 or 2 more paragraphs and send that to all my advisors, right? And then maybe send that out to all the employees too, right? There's generally like a cascade of, okay, I can't include all of that with everybody, but you want to be reusing that to broadcast it out.
One of the important things about that too is that you really are on a regular, consistent schedule, but you don't set yourself up for failure by making that too frequent. But if you're erratic about it, it actually, I think, kind of detracts, because then people wonder in between what's happening in the gaps, et cetera. So decide it's monthly, and then literally block off time in your calendar to make sure it gets done, so that you are consistent with being monthly.
And your investor update is not a game where you try to figure out how you position your company to make it sound like it's doing the best that it can. I think a lot of people do that, where they they only want to talk about all the great things going on and have their headlines of here's how things are going great. And that's actually not a very good use of that. You really want to clearly try to be honest with the challenges you're facing and things like that. If you are going to run into problems or have challenges later, it's way better if you can say, oh, I've been talking about that in my investor updates for the past 3 months, versus investors being like, oh, what the hell? How come this is the first time I'm hearing of this? You're low in cash? What? No, that's something you should be an update. Hey, or if a fundraising's coming up, you kind of talking about that, hey, we're planning on starting raising funding in 3 months, and things like that.
Yeah, there's one small quibble, is that you want total transparency. Number one, total transparency, because everyone, from your employees to your partners to your investors to the media, is going to be assessing your credibility, and that's something that you can't undo once it's been injured. It's almost impossible to undo that. At the same time, if you're not excited about your business, then you shouldn't be in it. So while you do want to have total transparency and not hide challenges, your job as CEO of your startup or of any company, almost the #1 job in leadership is to be the principal cheerleader. Right? So you've got to be excited about it. You've got to fire up everybody who's working with you on it. And you better have that passion and energy for it. That doesn't mean that you don't have the downtimes as well, but you carry that on your shoulders, not on other people's shoulders, as the leader of the organization. So, and Ted's updates are really good because I think he strikes exactly the right balance. I mean, you read his monthly updates and you get the sense he could not be more excited about the opportunity in front of him. And then he says, and here's where I need help. And that's the snip-snap one that Steve's going to circulate.
Other questions? All right, well, how do you ask for money? How do you ask for money? You should be asking for it every day. How do you do it?
I'm not a great example of it.
You're right, Josh. How do you ask for money?
So the classic saying goes, when you want money, ask for advice. When you want advice, ask for money. And that's pretty true. First of all, with your initial people you're talking to, you want to stack, kind of like stack them up. Do not go, I think very common is people kind of blow their chance on their investor they wanted to talk to most because they go talk to them first. And this is the kind of thing like it takes practice and you learn a lot from talking to investors. So pick people to go practice on that you actually like aren't the ones you really want yet and go do a couple sessions with them. As you do it, the conversation generally starts off with, hey, I'm about to go start fundraising. I've been working on a deck and I'm trying to figure out how to think about it and valuations and things like that. Would you mind looking it over with me and giving me some advice? And that's like a really kind of takes the edge off of them feeling like you're pitching them. And then what you're looking for is for them out of greed to hear the pitch and go, well, crap, I want to get in this before you go talk to a bunch of people, right? And that's the whole like ask them for advice and then see if they offer to invest. And if they don't, then that's also part of your sign that, like you shouldn't have to ask them, like they should want to. Like if you're talking to an investor, they're looking for investments. So if they don't offer it up, like that's, for me, that's like one of your good tests of like, are you ready yet, or are you there? And then, some other little things, I wouldn't, as you go sit down with an investor and you talk with them, the worst possible investor meeting is one where you sit down and you open up your pitch deck and you go through your pitch deck from beginning to end and stop and you got to give your pitch. That was a terrible pitch. That means they were probably checking their email the whole time. If they're engaged, they're going to be interrupting you and asking you questions. And the very best investor conversations, you don't ever get to open the deck. You sit down and you start talking. And they say, well, so tell me about this, whatever. Or like, I had this question, I've been thinking about it, and you just jump into a discussion and they're asking questions, you're answering questions, you're talking about the business, you're prepared to talk about it because you created the deck, you know how to talk about each of those components in there, but you might never open it up. Or maybe they ask a question and you go, oh, you know what? Actually, I've got a great slide that helps frame that thing. Let me open up, and you jump right to that slide and you say, great, here's what you were talking about, and you can kind of use the slide to facilitate it, but you're not just walking through the deck. And I think that's something a lot of early entrepreneurs will go in thinking, oh, I'm going to give my pitch deck, I'm giving a pitch. And they almost get frustrated or annoyed when the investor takes them off the path. And they want to keep going back and like, well, let me just go back to my deck. I'm going to come to that later. No, they're asking about it now. Answer it now. Like you've got them engaged. The most important value of the investor conversation of that pitch thing is having an engaged conversation with them, not getting through your deck. And I think a lot of people miss that.
I think he's 100% right. Just a real quick caveat. Later today, that's not true because we've told Live Oak, hey, that we're practicing for demo day, so they're not going to interrupt you. Right. So just don't take that.
It's different than a pitch day presentation. Yeah, demo day presentation or something. Totally different.
Want to make sure
when you're sitting down to talk to them, you don't want to get through your deck. Yeah. You want to have them interrupt you. You want to even like, if they are expecting the deck and they sit down, then like go do the first slide and then just make an awkward silence. Like, so. You have any questions about that? Like, what are you thinking about? Like, just try to get them to go off the deck, right?
Yeah, a couple of things to just add to what Josh said. The best time to raise money is before you need it.
Yeah.
So you want to start those conversations as early on as you can. And what you want to do, this is what has worked. Actually, the second round of financing, after our seed round that we did at Monte, we did actually have to go out and raise money. Or at least we thought we were going to have to go out and raise money. And what we did was we went down Sand Hill Road, spent 2 days, saw probably 20 different VCs. And remember, it's their job to take these meetings, right? So nobody's doing it out of courtesy or any other interest other than self-interest. And what we said was, we expect that in 6 months we're going to go out to raise. And we just want to get on your radar screen, let you know what we're doing, so you can start following us. Okay, you can get to know us, we can get to know you. And by the way, a great way for you to do diligence on us is for you to introduce us to the portfolio of companies that you have that might be customers for our product.
Yeah. That's the way you get a VC.
Yeah. So, introduce us to your portfolio where it makes sense. We'll see if they are interested in using our product or service. You get to learn about us. We get to learn whether you can really deliver what you say you will deliver. During that process, what can happen, and what Josh was referring to, is the preemption. We're going to go out and raise in 6 months. Okay, well, I don't want you to go through that process in 6 months because I don't want to be in a competitive deal. So let me offer you now, let me make it real easy for you. What valuation would you be looking for? And typically in a preemption situation, okay, we'll give you that plus something on the valuation. And then that discussion starts that way. That's really hard to accomplish, that last part. Preemption is very rare. But the first part is a really good approach to get on the radar screens. And you have to be selective about who you're going to. So for example, when we did, the reason we went to Silicon Valley, and our investors turned out not to be from Silicon Valley, but the reason we went there is because we were a SaaS business. And back in 2008, 2009, during the nuclear winter in venture funding, after the economy just completely imploded, they were the only ones who had SaaS experience, understood the SaaS model, and were doing SaaS investing. By 2000, I guess we did this in early 2010, other investors were there and preempted. But the one thing that you can do is you can get those meetings. It's always helpful to have a warm introduction. We know a lot of those investors pretty well, have good relationships with them. But go there before you need money, and go there with a different goal. Not so much of getting money, but getting customers.
Yeah, that's brilliant, really good thing. Both in how can I kill two birds with one stone? How do I get value out of VCs while they're trying to vet me? Well, if I can get customers out of it, that's the best value, right? Get them to bring me customers, which then even makes me more attractive to them. And probably one of the most compelling things to a VC is having one of their own portfolio companies that they already invested in and like and trust, tell them how great your product is because they're using it, right? So that's brilliant. I think another thing that's a common saying I attribute to Mark Sister. I don't know if he's the one that actually came up with it, but he says, I invest in lines, not dots. So he wants to meet you, see you do something, see you make progress, not just meet you once and invest, but see how you perform over time to get to know you. And related to that, something that I found to be very true, I feel like that the easiest way, particularly for angel investors, I think it applies to most investors, one of the easiest ways to get an investor is just to tell them that you're going to do something and then do it. And that sounds so easy, and that is so hard. For any of you at the stage your company is at, to be able to predict anything about what your business is actually going to be doing 2 months from now is extremely difficult, and generally everybody does a very bad job of it. And yet, if you are able to do that, that instills great confidence in the investors. What they want to see is, I came in and I said, hey, here's what I'm going to do over the next few months. I'm going to do bang, 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 bang. Then you come back and you're like, hey, remember I told you I was going to do bang, bang? Well, guess what? I did bang, 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 bang. That, just that is huge. And so being able to meet with them early, set expectations, say, here's what I'm going to go do, and then go do it, super, super valuable. What's really hard is not promise on the moon, which everybody wants to do, and then doesn't achieve, and then that backfires, then makes you look bad.
And Steve may have talked about this, or Carrie may have talked about this earlier, so if I'm repeating something, because it's sort of in the Dreamit playbook, forgive me, although it's worth repetition. Do not leave any investor meeting without asking the following 2 questions. What would you need to see in order to invest? Make them tell you what's important to them to see. And then reinforce it by saying, so if I come back in 6 months or 3 months or whatever it is, if I come back in 3 months and I've achieved X, Y, and Z, whatever they set out, you will invest?
It's been said many times, it has not always been followed through, because I talked to all the guys after they leave, so it's good to repeat. Josh, I told you only an hour, we're 1 minute over, and you know.
Whatever you guys want to do.
Real quick, do you guys have any last thoughts you want to make sure you leave people with?
Jeez.
Okay, then I'll take one more question. I saw a question over here. Go
Blank
ahead.
I'm going to
canvas.
follow up about Mark Sester's comment about investing in lines, not dots. I've heard that for VC investments, it can go months in terms of the first conversation to when they actually invest. Is that the same case with AngelList, or is that process much more compressed? And what's the best way to interact with individuals through AngelList, through that platform, if you are trying to shorten that timeline?
It's generally much more compressed. I think many angel investors on AngelList invest in dots. And many of the times it's one phone call and they decide to invest, or a phone call and then follow up a week later and make a decision. It's my experience. It's very, very often very, very quick. Dave McClure's like that too. It's like one meeting, put this side right there, I'm in, you're done. Like, just different people work different ways. And then others are going to take more hand-holding.
Okay, great. Josh, thank you for having us in, and also
Yeah,
for your
thanks for
time.
coming over.